Namaste everyone, welcome to the lecture 4 of Fundamental Analysis of Companies. In the previous lectures, we have done the profit and loss statement and we have also understood the balance sheet. This lecture will be focusing on the cash flow, and apart from cash flow, we'll be doing all these things later on in our future lectures. But the reason we are focusing on the cash flow today is because cash flow signifies the total cash coming in and the total cash going out. Now, if you can understand and analyze how much cash is going out, you can know a number of things. The second point which we are going to focus is on the free cash flow, which will basically tell us the effect of credit-based sales on the liquidity position of the company. When I mean liquidity, it basically means how quickly can the company come up with money to pay its bills or for unforeseen reasons. Now, credit-based sales is something for which suppose I have sold a product, but for which I have yet not received the payment. So that can have a huge impact on the liquidity position of a company. So let's start our lecture. Now, cash flow can further be bifurcated into three major parts. The first is cash flow from operating activities. The second is cash flow from your investing activities. And the third is cash flow from your financing activities. And the reason why we are segmenting it down is because we wanted to focus on a small niche and we wanted to try to understand how that particular niche is doing. Like when we say about operating activities, we wanted to understand how much money is yet to be received. The credit-based sales. The second is how much money I have to pay back. Suppose I have a car showroom and I get 20 cars from the manufacturer, so I have to pay the value of the 20 car to the manufacturer, right? The third is inventory. Suppose each car is of 10 lakh rupees, then I have 2 crore worth of inventory, which is currently lying there. I still have to sell it. Okay. The fourth is working capital changes. A working capital change basically means how much capital which I have has actually changed. Now, the reason why working capital can change is because suppose I have to receive money from someone and I've yet not received, so my capital decreases. Suppose I have invested a lot of money in a high-tech environment, in high-tech heat and ventilation systems, so that means my capital has reduced because I've invested somewhere. Or suppose I've borrowed a huge chunk of money from bank, then my working capital will increase because I have borrowed the money. So any change in working capital we also account in the operating activities. And the last we have direct taxes. These are taxes we have to pay. Okay, now let's proceed to our investing activities. Investing activities similarly means like we invest in stocks. Similarly, companies also invest in various number of things, which can be fixed assets. Say companies buying plants and machinery, say companies buying a car polishing machine or a car washer. Then the companies have investment in other companies or shares or bonds or golds and a lot of things. Companies also receive dividends from the shares which they have bought, and the companies also receives interest from the money which they have lent. And the last we have acquisition. Companies also invest to acquire new companies. Say I acquire a showroom which is next to me so that I can expand my business. Now the third segment is your financing activities. Now in order to expand or in order to do business, you have to finance your business. That's where the whole financing terms comes in. And financing would basically means the proceeds from borrowings. If I'm borrowing money from bank, how much have I borrowed? And suppose I'm repayment of my loans, that also comes under financing activities. Suppose I have to pay interest on that loan, or I have to pay dividend. Now if I'm a company and I am a public company, I might decide to pay dividends, so that goes into your financing activities. And the last we have your financial liability, the other financial liabilities, any miscellaneous things. But let me remind you, net cash doesn't always seems to be good. I mean, if the company even doesn't have a net cash, that doesn't mean that that company is bad. Net cash will basically tell you if the inflow was greater than the outflow or the outflow was greater than the inflow. Now, if I'm expanding, if I'm investing, my outflow could be higher, right? I mean, this is not a big deal. So let's first go to the screener.in and try to analyze this cash flow statement. So we are again at screener.in and let me type Tata Chemicals, the same example which we have taken previously. And let's go here on the top, you can see the cash flow. So let's go to the cash flow. Now, as we have discussed, it's broken into three parts: from operating activities, from investing activities, and from financing activities. So the first thing which you have to look is that the cash flow from operating activities is increasing. That would basically means that whatever business you are doing, you are getting more money as compared to your previous 5 or 3 years. Okay, so if you see from Tata Chemicals, from 2019 it was 1500 crores approx, and now it is approx 3000 crores. So the cash flow coming from the last 5 years has almost doubled, and accounting for inflation, I mean, this is not bad. Now the second is cash from investing activities, and you can see this cash is negative. That means from investing activities the net cash is outwards, they are expending it, right? So that, I mean, this could be positive also if you are receiving more than you are investing. So basically what you do is you take this from operating activities, you take from investing, and you take from financing, and you take the net cash flow. Okay. Now before going to the net cash flow, let's click on the plus sign on the operating activities and try to understand what all is in the operating activities. So you can see we have receivables. Now receivables becomes important because if you are doing a lot of credit based sales, and there are numerous examples where people have sold their products based on credit, their revenues have skyrocketed, but they never got their money back. I mean, yeah, this might have ring you some bells of some of the companies, and even a lot of banks go into bad debt, right? I mean, they don't receive their money back. So if you see here, their receivables increased and then it kind of decreased. So the trend is not very monotonous. I mean, at least it's not continuously increasing, so that's a good way. The second is its inventory. Now, if you can see, its inventory is minus 237. So we can see that the inventory is more or less increasing and decreasing. So that could happen because of the fluctuations in the business. But if you see that the inventories are continuously piling up, which we have also seen in the balance sheet, and you know how to analyze this. If the sales are increasing, inventories are piling up, not bad. But if the sales is decreasing, and that's the reason for inventories piling up, it's bad. You have the payables. Now you can see Tata Chemicals payables have reduced. I mean, as compared to the previous year, that's good. So they don't owe a lot of money to people, just on the operating part. And then the working capital change is this much. And then you have the direct taxes. So the major chunk which you have to see is the receivables. Inventory we have already seen in the balance sheet. You just have to focus on the receivables, and you have to make sure that the cash flow from operating activities is increasing. That's the gist of your operating cash flow. Let's go to the investing activities. You can see how much fixed asset are they purchasing. Okay. And how much fixed assets are they selling. Now, if you see a sudden increase in the fixed assets sold, that might account in your net profit increase, and that's where you have to see it. I mean, if your net profit increases because of the sale of your fixed asset, I mean, that wouldn't really count a lot. Some people might argue on it. The reason being, I mean, I am investing right now in land so that in the future I can earn. And when I'm earning, you are saying it should not be accounted in net profit. The reason why I'm saying it is because unless and until my major business is buying and selling land, I would only like to look at the core business. How is it doing? Okay. So it's debatable, yeah. And then you have investments purchased, investments sold, interest received, dividend received. Now you can see the dividend receipts are approximately 132 crores, and you have a number of other items. Now the just here to be see is the fixed assets sold. If they have sold any big fixed asset which might have caused an increase in the net profit. This is the first thing which you have to see. And investing activities cash flow can be negative or can be positive. You don't really have to worry about it, even if it's negative. I mean, they are just investing, right? And investing is not bad. You are also doing investing. Yeah. The third is the cash flow from financing activities. And this is basically proceeds from borrowings. How much money have they borrowed?
So if you can see, compared to the previous 5 years, I mean 2019 was only around 1000 crores, then it's 3000 crores, then it's 4000, then they have reduced their borrowings and again they have increased. So no doubt Tata Chemical has increased overall their borrowings. Maybe they are expanding their business. Okay, and but it should not happen. The thing you have to see, they are not borrowing the money to pay back their loans. I mean, if they are doing it, if they can't generate enough cash from their operations to pay their loan and they have to borrow the money, that's a bad sign. And there are other things also, like dividend paid, financial liabilities, other financial other financing items. So the main crux of seeing in this financing activity is basically the borrowings. How much borrowings is increasing and how is the repayment of the borrowings. Now comes the net cash flow. Now you might wonder that, okay, the net cash flow is going negative, but that should be okay. The net cash flow only tells you how much money is coming in out of how much money is going out. What we have to focus in is the free cash flow. So let's try to understand the free cash flow, which is going to be our major crux in the cash flow statement.
So let's try to understand the free cash flow. Now suppose you are having a sales, and sales can be done in two parts. Either you will receive the money in cash or cash equivalents, or you are going to get your sales done based on the credit. Basically, it means you are not getting the money right now, but you will get it in future. Now here is the issue, that in the future the person who is supposed to give you the money might default on it. And this has happened numerous times. I mean, this is not a new thing, and this is not very rare. Now the free cash flow calculation ideally has to be done from cash flow from operating activities minus your capital expenditure. Expenditures like in lands, factories, machinery, or capex, your capital expenditure has to be subtracted. But to be more conservative, what we would suggest is also to subtract your trades receivable. Means the money which you are supposed to receive in future, you subtract that also and get a net free cash flow. Now ideally, in terms of finance, this is how the free cash flow is defined. You don't really subtract your trades receivable because it is assumed you are going to receive that in future, but this is a more conservative approach. Okay, and then you have to make sure that your free cash flow is greater than your current liabilities. And if it is not, that means either you have to sell some of your asset or you have to borrow money to pay off your current liabilities, or you can defer your payment and then you have to pay penalties and you will basically drown your name if you defer on a repayment of loan. So let's go to Screener and try to analyze the free cash flow.
So now let's go to screener.in and let's type the same name, Tata Chemicals. And here what we have to do is, let's go down, and here you will see a peer comparison table, and we will go to edit columns, and in the column what we will do is we'll type here your free cash flow. Now you can see that you get your free cash flow last year. Just click on this and it will come here, and you can drag it initial or to last. So this is basically setting up your screen, and I've already set it up mine based on the ratios we are going to discuss in this lecture. So basically you can actually see all of these data in just one table, and also you can compare it with your peers. So I mean, this is awesome, right? You really don't have to analyze your peers, take your diary, note everything down, make your life hell. So this is very much easier. Now what we have to do is, you can see the free cash flow for Tata Chemicals is 1427 crores. And this looks pretty good as compared to its peers, but you can't really directly compare it. Let's look at the market cap. Do we have the market cap here? No. Let's go to edit columns and let's type here market cap, market capitalization. It comes here. Let's bring it to the second. Now you can't just list unlimited options here because that goes into the premium subscription, but you get 10 to 15, I think around 10 free columns, which is good enough. You can set up 2 screens and analyze. Now your market cap for Tata Chemicals is around 25,000 crores, while for Pidilite it's around 1,34,000 crores. So, I mean, if you compare to its peers, its free cash flow is pretty good as compared to its peers. Like 25 is this. If you see Deepak Nitrite, it has a 27,000 crores market cap and its free cash flow is not that high. So, I mean, free cash flow is not going to be your only parameter, right? You can't just look at it. That's why we have such a big course. You have to analyze various things so that your winning probability increases. And the reason I say probability, because it's actually a probability. I mean, if everyone is sure, we'll just sell everything and buy the stock, right? That's not going to happen. So let's try to also calculate it. So let's go to your cash flow. And the cash flow from operating is 2971 for March 2023. And if I go for investing, and I can see my fixed assets purchase was 1578 and fixed assets sold was 34 crores. So if I subtract 2971 minus 1578 plus 34, I'm gonna get this number. You can do it. So you will get your 1427 as your free cash flow. So this becomes important, and analyzing free cash flow. The free cash flow over the year should ideally increase. This gives the company the capability to expand, the capability to reduce their borrowings, which will reduce their interest, which will further increase their incomes. So that's why the free cash flow becomes very important.
So excited. I mean, I'm pretty much excited to recommend some of the books. So we are breaking down the books into 4 levels: level A, level B, level C, level D. And now don't ask me why do you break down everything into subparts. It becomes easier. So the first book which I would recommend, the level A book, would be The Richest Man in Babylon. One of my favorites. Pretty straight, and if you're very new to finance, these books will give you some good insights. Second book which I would recommend to you is The Compound Effect. Again, level A. And the third level A book which I would recommend to you is this, The Psychology of Money. So sorry, I'm not calling the author's name, and that's bad, but yeah, it's Morgan Housel. So just read the author's name. Don't feel bad. Don't fight me on the comments. The level B books which I would recommend is Rich Dad and Poor Dad. I think most of you might have already heard of one of this. If not, do read this. The second book which I would recommend you is One Up on Wall Street by Peter Lynch. And the third book which I would recommend you, the third level B book which I would recommend you, is Learn to Earn by Peter Lynch. Okay. Now the level C books. So the first level C books which I would recommend you is Freakonomics. I mean, these books will give you a different perspective on how to look the world and how to do correlation. It's pretty good, I mean. And the second is Bulls, Bears, and Other Beats. It's by an Indian author, and you'll be surprised who he is. Just read it. I'm not gonna tell you. And this has a good history of Indian economy too. So yeah. And finally, the level D books. So the Bible of stock investing, The Intelligent Investor. I mean, you are supposed to read this. This might look a bit difficult when you read it, but don't worry. I mean, it goes simple as you keep reading it. And if you really read through level A, level B, level C, this book will become very easier. And the last book, which is a bit tougher than this, is Common Stocks and Uncommon Profits by Fisher. So these are the 4 level books which I can suggest you, and I think these are a lot of books, so don't just jump on and I'm gonna read these books first. Keep sticking with us, and in your free time, keep starting reading. At least make your years or 1.5 years target to read all these books. You can bring in more books from your friend's suggestions, or if any one of your friend is an analyst. But yeah, these books are pretty good, and I've personally read them, and they kind of develop your thoughtful knowledge. They try to develop your strategic mindset, so that you, whatever you look, you can correlate it in a different way. So that's all for lecture 4, and we have learned cash flow, and we've also done some book recommendations. We hope you have liked the lecture and learned something new, at least got some new book recommendations, or exciteful that you have already read these books. See you in the next lecture. Thank you.